Now, the full scale of damage a no-deal Brexit could cause the UK has been revealed. Boris Johnson's government published its worst-case scenario last night, a document codenamed Operation Yellowhammer that it's tried to keep secret. The paper warned of food and fuel shortages, disruption to the supply chain, public disorder and intense pressure to return to the negotiating table if the UK crashes out of the EU with no agreement. The scenario undermines Prime Minister Boris Johnson's assertion that the UK can cope with a no-deal Brexit. MPs have passed a law intended to prevent Prime Minister Boris Johnson forcing through a no-deal Brexit, but he says he's ready to do it anyway. Paul Markham from Newton Investment Management is still with us. Paul, I mean, the scenario outlined there is really troubling, to say the very least. Is a no-deal Brexit something that you're bracing for at all at Newton?
It's been a really difficult decision to make. Obviously, the market was expecting a Remain outcome in June 2016, and those that were positioned aggressively for that were punished by the market. So I think from that point of view, it just shows you that taking a strong political stance within portfolios isn't necessarily the sensible thing to do. It's hard to ignore, though, as a driver of equity markets globally and particularly clearly within Europe and the UK. We haven't taken too much of a view either way. What we have been of the view is that sterling would be likely to be relatively weak for a period of time during the kind of twists and turns of the negotiation saga. I don't think any of us expected it to be going on as long as it has, or as sort of noisily as it has, but it's been right to be underweight to sterling, and that's meant to be, I guess it's meant being exposed to overseas stocks rather than necessarily domestic ones. As we go forward, I think, you know, if one takes most traditional valuation metrics, both on the currency markets and on the equity markets, the UK does look cheap, and one could be very well rewarded for being exposed to it for a period of time. But again, that outcome is going to loom very large in any decision that one makes in that regard.
What's your view on UK banks? Because earlier in the context of the ECB, we were talking about the fact that you're not very positive on European banks. Are you slightly more positive on UK banks? Well,
the thing with the UK banking sector is it doesn't suffer from quite the same malaise as the Eurozone banks do. Some of them do overlap, and there are some structural issues, which are pricing power, fintech, a relative lack of inflation compared to the past, although the UK doesn't suffer from that as badly as the Eurozone. The UK banks do have very specific stock-related issues in each case, and we have very different business structures actually among the big players in that market. And clearly there are some question marks around the UK economy which would be difficult post a harder Brexit outcome for those banks to be driving their revenues very, very effectively. So I think the valuations do look optically attractive, and certainly some of the cash returns from those areas can be pretty good, but there is no reason, you know, we could look across at some Eurozone banks trading at 0.3 times book value, and that's something which we couldn't preclude happening to the UK banks as well if there were a hard Brexit scenario.